In the interest of time, let's talk about Meta and Snap. So for PE, for Meta, did you get numbers similar to this? With a G of about 6%? I mean, you could have chosen an ROE 22, 23-ish, 24, anywhere in that range would have been probably reasonable. It's a slightly different G, but pretty high G, around 5, 6%, 5.5, 6%. Look about right. What about Snap? What'd you use for their ROE? That was not the cost of equity, so that's pretty easy. What'd you use for their ROE? This is their next 4 years of EEO. What would you use? First of all, why is the return on equity big negative the next 3 years? Why do they have negative return on equity? Yeah. Well, if you look at the top of the screen, the answer is because they're losing money. So negative profit divided by equity, negative ROE. Why does it turn positive in 2026? Still have a negative profit. So one or two things is happening. There's a double negative there, or something else is going on. But the point is, their return on equity is kind of meaningless right now. Right? And it's meaningless because they have not built a profitable business model. So you're still betting on a future that isn't here yet when you buy Snap, right? So this company is being priced as if it's not being priced of today. It's not even being priced over the next couple of years. Like if you're buying Snap, you're betting that this company is going to finally make money in a few years. That's what the valuation is based on. So the perpetuity is more based on the future than it is today. So the problem is what we've been doing with these kind of established big companies, which is why it's easier to start with that. You know, Meta is a mature, big, profitable company, right? That's been the same with the Mercks, the AbbVies, and even when we started with the Costco's, the Walmart. So those companies are already making money. They have established business models. They're pretty understandable about that today's looks kind of like tomorrow, and I can predict them. Snap, it's roll the dice, right? People are betting that Snap is eventually going to make money, but they haven't made money yet. So they're being priced on that bet, okay? Now it's a probabilistic bet. That's why they have a higher cost of capital. But the point is, I had to figure out what is that perpetuity return. And so here's the first thing I would say is since they're not really expected to be profitable until year 4, in this case 2025, 2026, I'm not going to use the second year forward multiple. I'm going to use the third year forward multiple because they don't even have a positive EBIT until 2025, right? So doing a multiple on a negative EBIT is really hard to do. So I couldn't really use the 2025 multiple. I'd have to use either the 2026 or 2027 multiple when they're profitable. Now the point is when I use 2025, their EBIT is so small that their EV to EBIT, given they have some expected future value, is going to be extreme. That's why that multiple is really high, right? So Snap is not easy because what it's going to involve is making some assumptions, right? Same thing. What's their tax rate? Well, if you look at the analyst reports, because there's no guidance, tax rate's either 0 or slightly negative for the few years because they're not making any money. So you're not paying taxes. So that's not going to last forever. Nobody's going to fund a business that doesn't last forever. So they eventually have to make money. So we got to figure out what kind of tax rate are they going to pay when they're profitable. So in this case, we might benchmark. You know, hey, what are the other tech companies paying? High teens. Maybe I'll put in a high teen tax rate as a reasonable assumption, 18%. Somewhere around a Facebook or others, kind of proxy out. This is what they should look like when they're profitable. So that's the point. This is going to be an assumption. We've got to make some assumptions here. right? So assumption number one, what kind of spread, assuming they get profitable long term, are they going to make, right? I don't think they're going to be as profitable as Meta, right? But maybe their return on equity looks close to Meta, all right? So I'll put a 20% in for the long term, okay? Now I can actually start to solve for a growth rate, okay? So that's the point. I'm going to have to assume what would they look like in perpetuity? What would they look like if they established themselves as a business model? And then I can solve for a G. Right? Your G is going to be heavily dependent on what you think that spread's going to be. Right? So again, you get a higher spread, you get a lower G. You get a lower spread, you get a higher G. But either way, to get a multiple of 28, they're going to still have to see some growth. And I would expect that. I expect Snap, still early stage, to grow as they go to profitability. So I would expect this to be a fairly high G. And at a 20% ROE for a company like Snap, I goal seek this to their current PE. Again, they're like a Tesla. Very high growth at a pretty decent margin, decent spread. I make the spread higher, growth still a little bit lower, but still going to be a very high G. Yes? Question? Sorry, raise hand? No. All right, back to EV to EBIT. Same thing. What's my tax rate going to be? Say I use 18%. Okay. What's my ROIC going to be? Here's the other thing I want to tell you. ROIC and ROE are related. We mentioned this before, right? Very proxy, but like, you know, if ROIC is kind of like return on debt and equity, and ROE is return on equity, then what's going to drive the difference between the two is the leverage ratio, basically the debt to equity ratio. So that's the point. If I have an ROE, I can proxy an ROIC. If I have an ROIC, I can proxy an ROE. They should be somewhat related by the debt to equity ratio. So that's the point. If they don't have a lot of debt, you know, cap structure, I can even look at their cap structure, but, you know, think of it this way. If the ROIC is going to be less than the ROE with any leverage, so if they got a 20% ROE, that might be, depending on their leverage structure, a 15% ROIC. And then I can actually solve for a multiple, right? So I'm going to have to make a bunch of assumptions here, right? And the assumptions are actually be, what do I think the market believes when they turn cash flow positive and they have a sustainable model? What does that look like? If I'm doing a company like an Uber, if I'm doing a Lyft, if I'm doing a DoorDash, I'm doing the exact same thing. Because for the next several years, all of these companies are not making money, yet they have value. And the only way that you have value, you're not making money now, is people believe that you're eventually going to make money later. So this becomes much more difficult to do on a valuation standpoint, because now you're making a lot more assumptions. All right, so there's one assumption. You're going to make multiple assumptions about what is reasonable for where this company might be. Obviously, it's going to be a range, but that's what you would have to do in this circumstance, and then just basically really explain your assumptions. But that's why I said these become much more difficult companies to value. Right? Now, by the way, this is also why there's a lot of opportunity in Snap, right? Because no one, with all these assumptions, really knows what Snap's going to do in the next 5 years. And the question is, can they actually turn it around? Because if any of these beliefs change, they have the biggest drop, because that's the whole point. There's no underlying value here. All the value in Snap is of the entire future. And if I start to fret that that future is not going to be attained, this company can fall really far, really fast, right? And that's the problem. They don't have any floor. There's no cash flow that I'm really basing it on the next few years. It's all betting on a come that they're going to get to that cash flow coming up. Right? So there's gambling here if you invest in a company like Snap. It's also why the cost of equity and the cost of capital is a lot higher. Right? So putting in these assumptions, again, the whole point, which is reinforced even with these assumptions, if I goal seek this, using those numbers, by setting this to 75, which is a crazy multiple. The only way I'm going to get that, again, was with a high G. So that's the whole point. This company, these types of companies, are entirely a growth bet. Right? It's what they call growth stocks. Right? It's not about the profit, it's about betting growth on future profit. So they're going to be extraordinarily sensitive to growth. And that's why my question to you, when I said how many are using Snap, is actually a very important question. It's not a ha-ha question, that's the point. Like if the younger generation has moved on, as they seem to do, with these social media platforms. And Snap's not going to get that growth and profitability, and the advertisers aren't going to show up, then they're not going to get this growth, and this multiple is going to be a facade, right? And that's what I'm saying. This is going to be a challenging company. That's what happened to Twitter. I mean, Musk bought them. Take all politics aside, he paid $45 billion. Best case scenario, they're worth half this, is what they're estimating now, based on the numbers that are trickling out about Twitter. Because that's the point. Like, people are moving on. They're moving on to other networks. And we saw that. We've seen that several times in the social media world, that people are not as sticky, with a couple of exceptions. The one exception we've had so far is Facebook. Right? But even Facebook is starting to show some cracks in its usage as people are starting to move to other networks away from Facebook, and they're not seeing the growth that they were expecting. And so that's the point. That's why Zuckerberg is really having to scramble. He made a big bet on growth on the metaverse. Nobody's shown up. Right? I mean, basically in the metaverse, you got a few porn companies. That's about it. Right? I don't know who else is in the metaverse. And that's the problem. Like, the masses have not gone to the metaverse. And maybe it will. And maybe we're just early stage, and this is going to play out completely differently in the next few years. But it really hasn't. And so that's the point. They're in search of growth because their business is seeing its growth start to slow. Like any other company, we would expect this to happen. And the market's trying to figure out where their next growth vector is going to be. In the case of Snap, they expect a lot of growth. The question is, will the business model support that growth? That's going to be the underlying question. But that's why this is actually a very risky stock. But nonetheless, we're going to have to make some assumptions about what we think it's going to be. Questions, comments, concerns about any of that? You shouldn't have that trouble with Apple, Alphabet, and Meta. Okay? But as I said, when you start dealing with some of these outliers, which I think are pretty interesting in valuation, these are some of the questions that you'd have to come up with. All right, so again, make sure, take advantage of being here. Get all your data for Homework 13. All right, I'll see you guys on Monday. Make sure you turn that in. And please meet with your teams this week. Get started on your Parker Hanford.